Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 8, the Group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problems. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. Now, in the last video for 8-35, this here was, the essence of this exercise was calculating straight line depreciation and the effect when you have an error, what effect does it have on the balance sheet and the income statement? And I had said, go back and watch the theory videos for straight line, for depreciation, and also go back and watch the framework videos in the introduction for the relationships between like the balance sheet and the income statement. When you make an error, it doesn't affect just one thing. That effect ripples throughout your entire books. Now, I'm looking at 36B here, and it says here depreciation methods. And without reading this, I looked at the requirements here, and I'm seeing prepare a schedule of depreciation expense for the equipment under 3 depreciation methods: double declining balance, straight line, and let's see, units of production. Okay, and in essence, my feeling on this is that you reach a point where you can't keep going back and going over the theory that you should have learned previously. Okay, and that's kind of like a point where we're at right here. I mean, you should know the depreciation methods. So if you don't know them, then you have to go back and you can, it was covered in Math for Business and Finance, Math Applications. The videos are in the Math for Business / Applications section of the business group on the student community. In the theory videos for financial accounting, watch those videos because that points back to the math. All right, so you've had it in math, you've had it here in financial accounting, you should know it. If you don't know it, I'm not going to go back and try to explain it again for the third time. Okay, go back and watch those videos. So in essence, in some of these here exercises, as we're moving forward, and some of this material that we're covering, I'm not going back. You go back. It's something that you should have learned previously. So I'm just going to push forward and only cover the content that is quote unquote new. All right, all the old stuff, that's your responsibility. Okay, and that might sound harsh, but that's the reality of it. Okay, I can't spend a lot of time going over the same thing again and again and again, just like I am explaining this to you. Okay, so let's go. Mercy Medical Center bought equipment on January 2nd for $38,000. The equipment was expected to remain in service for 4 years and to perform 800 operations. At the end of the equipment's useful life, Mercy estimates that its residual value will be $2,000. The equipment performed 90 operations in the first year, 250 the second year, 240 the third year, and 220 in the fourth year. Prepare a schedule of depreciation expense per year for the equipment under 3 depreciation methods. Okay, after 2 years of double declining balance depreciation, the company switched to the straight line method. Show your computations. All right, which method tracks the wear and tear on the equipment most closely? I'm going to answer that question right up front because this is something you just should know. That would be units of production. Because you're matching, Units of production is basically, excuse me, the wear and tear on the equipment. Um, for each unit that you produce, you have the wear and tear. Straight line and declining balance don't do that. All right, number 3, which method would Mercy prefer for income tax purposes in the first years of the equipment's life? Explain in detail why a taxpayer prefers this method. I don't have to create the schedule in order to answer these 2 questions. All right. Number 3 here, the method preferred to use for income tax purpose would be the double declining balance method. All right. And the reason why, it provides the most depreciation in the first years. Okay, so you get the greatest tax write-off in those first years. Okay, and this this saves cash in the first years, because you're expensing more, which means you have less profit, and you're keeping more of your cash. And generally over the course of a piece of equipment, generally pieces, even though there are 2 schools of thought. I mean, does it really matter when you're going to actually keep the equipment for the full period of time that you're going to depreciate it? No, it doesn't matter. It just matters as to how you're, how you want to, record your profit or loss. But generally, if you keep it for a long period of time, you can go straight line versus double declining balance. But realize that you're talking about financial accounting. You're really not talking about tax accounting. And also, a business would prefer to capture their expenses as soon as they possibly can, instead of deferring them to later. Okay, and so that's why you would kind of want to use double declining balance. But the real reason is that when you do your income taxes, you're going to follow makers. All right. That's the schedule that you use in order to depreciate when you're doing taxes. And makers most closely conform, double declining balance most closely conforms to the maker's method. Okay, so if you want, remember, you have financial accounting and you have tax accounting, right? Financial accounting is, how you present your books financially for third parties, investors, for getting loans, this and that. Tax accounting is how you report to the government for taxes, right? Now, they're both related upon the same set of books. Okay, I mean, you take that information on your general ledger and you're going to create your financial statements, but you also take that same information and you put it on your taxes, which differs. These are not equal. Okay, so on your financial statements, if you want your financial statements to more closely conform to your taxes, then you want to use the double declining balance. However, financially, that might not make the most amount of sense. It might make more sense to use units of production or straight line depreciation. Okay, but when you're using taxes, you have to use makers. Okay, and you have no choice in that matter. Okay, so if you want, like I said, you want your financial statements to look like your tax statements, you'll have more of a tendency to use double declining balance. But if not, because you want to get a loan or whatever have you, or you're presenting the information to outside investors or whatever have you, you want to present your financial statements in its best light, and which method you choose to do that as far as depreciation is concerned, that's up to you. Okay. So that was all covered before in theory videos. Okay. And you can go back and watch those. That just answers 2 and 3. So number 1, we're going to prepare a schedule of depreciation. All right, so we're going to have here year is going to be 2014. Let's see here. And it's in service for 4 years, so 2014, 2015, 2016, and 2017. And this here, honestly, I mean, I don't know why I'm going through this, because this is doing nothing more than creating, depreciation schedule. Again, covered in theory before, right? So we're going to have straight line here. We're going to have units of production here, and we're going to have double declining balance here. Okay, so for straight line, we have 38,000 less 2,000 for our residual value, which means we're depreciating 36,000 by 4 years. That's 9,000 per year. Okay, so our schedule will have for straight line 9,000 for each year. Okay, for units of production, okay, we have to take the same 36,000, and we're going to divide it by 800 units, okay, which gives us $45 per operation. So in the first year, it says here at the end of the, let's see, the first year there was 90 operations, so 90 times 45, 40. So in the first year, we have 4,050. In the second year, we have 250, so 250 times 45, and that ends up being, let's see here, 0, 25, 2, 12, 0, 20, 8, 10, 11, 250. Okay. In the third year, we have 240 at 45. So watch what I'm going to do here. Okay. 250, we had 250 less 240. The difference is 10, right? 10 times 45 is $450, right? So I'm going to subtract the $450 from the 11,250, and I get 10,800. Okay, I mean, that's how I did it, relatively quickly without going through all of that long math that you saw me arrive at 11,250. If you want to go and say 240 and multiply it by 45, knock yourself out, use a calculator, right? But notice I did it just in my head here, okay? And then I can do the exact same thing, because in the fourth year, right, I'm talking about the difference between the two of 20 units, right, at 45. So that's 0, 10, 8, 9. So 900 from 10,800 is 9,900, okay? Just quick math in your head, right? If you don't take shortcuts, it takes you a lot longer, okay? All right, so anyway, that's math. Double declining balance, okay? So let's see here. So we're using double declining balance, so we're using a factor of 2, which is 50%. Okay, so I have 38,000. So I have 38,000 times 50%, right, which is 19,000. Right? So I have 19,000 for my first year. Okay. In year number 2, right, I have 38,000 less than 19,000, which gives me 19,000 as my book value, and I'm taking 50% of that, right, which is 9,500. So that's in my second year. But now, in the third year, it says here, after 2 years, after 2 years, so this is my third year, the company will switch to the straight line method, right? So my book value at this point in time is 9,500, right? 38,000 less 19 less 9,500 gives me 9,500, right? And now we're going to switch to a straight line, so we have to subtract out our 2,000 for our residual value, which gives me 7,500, and I'm going to divide that by 2 years, okay? Which means that I have 3,750 for the remaining 2 years, okay? So if we add these all up, this is 36,000. Remember, we have $2,000 in residual value here. We add all of these up, that should be 36,000. Still have 2,000 in residual value, and we add all of these up, we should have 36,000, right? Because we have 2,000 in residual value, right? So that's it for this exercise. If you, like I said, if you don't understand something, go back into the math section, Math for Business and Applications. If you can't find that, watch the theory videos that in this for financial accounting, which has the links and the web address in the student community to be able to go to the math and watch, work through that depreciation stuff. Okay, and then if after you're watching all that and you still don't understand, feel free to contact an instructor. Okay.